I was asked by Dr. Lipnick to, thank you, Dr. Lipnick, to talk to your group about what I think are the most important financial decisions you have to make during the course of your career and beyond your career into retirement. So I bring a lot of years of experience advising individuals and a lot of physicians on what they should be doing now to prepare for retirement. And from that wisdom that I've hopefully gained over the years, I'm going to give you a few pearls of wisdom, my wisdom, that you might take home with you and think about. So when I think about retirement, you can look at this slide I have up. I actually stole it from a company that specializes in providing retirement planning to airline pilots, and they call it, coming in for a landing. So some of us are very low to the ground, like this plane. Some are at 40,000 feet. But as Deborah said, most of us are under the 10,000-foot ceiling, and we're going to be landing pretty soon. So with that said, I'm going to go through this, and I'm going to try to go fast because I'm the only thing separating you from the exhibit hall and a glass of your favorite beverage. So is this thing working? It's green. All right. So we're going to cover the number one thing I think that you should consider is, I now work for a really large accounting firm, the fifth biggest in the world, and accountants specialize in watching expenses, and it's true for your personal financial life as well. So we look at expenses. We're going to do some sample projections. I've got some hypothetical people here to look at. We're going to show you how to maximize your tax-efficient funding, and I'll have a few recommendations. So the biggest thing, and I think somebody in this room may have told me this, but it's not what you make, it's what you keep. Can we all say that? It's not what you make, it's what you keep. You can make $600,000 a year for 20 years, but if you live very extravagantly, you can look at your retirement fund and it's going to be way underfunded. So we know that there's a lot of demands on your financial resources, and I'll get into that in a second. The big question I got, and I just got it 5 minutes ago, is how much do I need to retire? It's a big question. It all comes down to the lifestyle you want. If you want to live in the Silverado trailer park and drive an old pickup truck, you can retire on very little. But most of us have gotten used to a pretty nice lifestyle, and we'd like to continue that lifestyle into retirement. And so that will require a significant amount of money. I'm going to go over a net worth statement and how important it is to monitor your net worth or your balance sheet. We'll do some retirement projections, and then I'll show you again how to maximize your savings by not paying taxes and then putting the money in the bank, but save it before paying taxes. So let's talk about managing your expenses. So you all came out of med school, and they probably promised you what this person is talking about with college. You're going to graduate and you're going to have it all. It reminds me of that Talking Head song where they say, how did I get here? But you have the home, the family, the minivan, the dogs, and so you look at your own self and you say, okay, do I own a home? Do I own a second property? Do you have fancy cars? You buy nice jewelry for each other every year? Do you take big fancy trips to the Tuscany and stay there for a month? And one of my favorites is, are your children still on your payroll even though they're in their 30s or late 20s? And I know the answer to that. So why is it that doctors really don't address this early on? They come out of grad school after working, not grad school, medical school, and residency and everything else. And they typically may have already started a family. They find themselves in incredibly high debt, big student loans to pay off. And they have to pay for the schools, the vacations for the family, the house, the cars, everything just adds up. So the average doctor has less than $500,000 saved up and a net worth of less than $1 million. And from my experience, I've seen that. I've seen a lot of physicians that, and I was told to take this off. Hang on a second. Sorry about that. So I see these doctors that work, maybe not specialists like you folks, but they don't have hardly anything saved up. And it's really sad to see, because I know how hard they've worked to, garner their medical degree and to practice. And so, my passion is trying to get these people to do some financial planning and get them on the right track so they can have a reasonable retirement. So when you retire, I'll just talk about this for a second. I threw this is retirement smile. So when you first retire, you start traveling all over the place. All the places you couldn't go to when you were working, and you spend a lot of money. But then it kind of slows down. I'm tired of going over the pond to Europe or whatever. And you get into a stable situation where you're not spending very much, you probably have no debt, and then the healthcare costs start kicking in, and your spending goes right back up. So it's hard to say how much do you really need in retirement, but we're going to use an example here. I can't even read this. So I went over sort of the earnings and some rules of thumb. So Social Security will provide a small amount towards your retirement funds, but I can't read my own slide here. I'm sorry.
You want to step over?
Oh, here we go. This might be easier here. So you won't need as much as you're spending now, but you're going to need about 70% of it. Your taxes are going to be lower. You're going to get a little bit of help from Social Security. You're not going to be saving, so you don't need to earn quite as much. So in this example, $300,000 pre-retirement, you'd only need $210,000. So if you look at a 4% paycheck or income flow, you would need roughly $5.25 million. That's if you want to maintain the value at through the end of your retirement years or your life. And that's a real hit over the head. That's a lot of money. And I'm sure a lot of people aren't prepared for that. There are some sample projections here. So we have two professionals, gender neutral, 4.25 from one of the professionals, 90,000 from the other. They're married, a couple of kids, probably just one going into, one getting out of college. They've paid off their student loans, and they want to retire at 67. Full retirement age right now is 66, just so everybody knows that. So here's what their situation looks like. They have about $2.5 million in net worth. They've got some money spread around in taxable investments, retirement, an annuity, some real estate, and it's owned in different ways. So the individual stuff probably should be, except let's say they're all retirement, Sam's Living Trust should probably be put into a joint account. But that's, probably a pretty typical net worth statement for a physician, a specialist in their late 50s. Their other assets, the vacation home, that's the second home, cars, and what I don't like is the liabilities over there from the mortgages. So they want to retire spending what they're spending right now, which is roughly $250,000. And so we're going to run the projections and see what they can do at age 66 and how long it will last them. So they both retire at 60. They're retired at 67, really 66. We have an inflation rate built in, and we show them both passing at age 95. So we're keeping their expenses at the same level, 243, and we're indexing it for inflation over time. There's also an investment rate built into this. So they'll run out of money right at the time they die. The last check they write, and then they're going to die. Okay, it'll probably bounce. 95. So, this is kind of, it goes away very quickly when you don't have all that earned income coming in. So here's a Monte Carlo simulation of that. This is running like 1,000 different scenarios with what the market's doing and everything else. And their probability of success is not very good. That's why it's all red, 58%. They could end up with more money than they expect, but they also could end up with less money on the worst case scenario. And this is just basic retirement planning here. So I thought that joke was pretty good. You all know what liquidity is now. So here are some things you can do to enhance your probability of success. If you're young, there's some very young people in this room. Invest more aggressively. Max out what you can put in all your retirement plans. I had a CPA when I first had my own business, and this fellow just passed away. I went to his funeral last week. He said to me, whatever you do, max out what you put in the pension plan every year. He says, don't buy another house, don't buy another car, max out the pension plan. And he was absolutely right. And I'm so thankful that he gave me that advice. Try to max out Roth IRAs, but most of you probably still make too much money to convert to a Roth right now. Avoid high-cost insurance products. A life insurance policy is not a place to save money. It's for insurance. Reduce expenses within your portfolio. Most portfolios we see when they come to us, they're pretty loaded up with expenses. Individual investment managers that are charging too much, plus within the fund, they might have a lot of mutual funds that are also charging too much. So, we're big advocates of tax-efficient and low-cost investing. Somebody comes to you with that offering memorandum to invest in some deal that you've never heard of, basically a private placement for equity or debt, or, I've got this great deal, invest in this company, walk away. Probably 99 out of 100 times, those things just end up being a tax write-off. You just can't, they just don't. If it was so good, why are they offering it to you? One thing, and I will cover, is don't take your Social Security payments right at full retirement age. You're much better off keeping them to 70, and I'll go over the charts on that. And the other two things you can do is make more money, don't get married, don't have kids. That helps. All right, so let's go back to this couple here. So we recommended to them, they're 58, they got 8 years to go, so we're recommending that they reduce their current expenses by $15,000 a year, and then consider adding an additional $100,000 a year into another tax-deferred account called a cash balance plan. And if they just take those two steps, here's what happens to their projections. So it says that it lasts a couple of extra years. You can actually see, way off to the right, they've got plenty of money when they get to the pearly gates. There'll be plenty of money left over. And so they may not have to reduce their expenses quite that much, and they may not have to save quite that much, but just making a couple of adjustments before they retire, they got 8 years to go, it gives them a success. They're now 94% probability of them achieving their plan, and that takes so much worry off of somebody. We know what anxiety does and stress does to somebody's body, but this takes all that worry out when they're looking at a 94% success rate, that they can retire knowing that they're comfortable. And if things got really bad, they could cut back on something and make it work. But that's a significant change. And it's sacrificing a little bit, from 58 to 66, but not that much. I mean, most of their, it's their peak earning years. They should be able to sock away a little extra money. And this is, again, the chart showing here what a difference it makes to be in that green. And I know it'd make me comfortable. So how can you do this in a tax efficient way? Here's Social Security, and I'm going to step over here. So you can see how much income you can expect to need replacing and how much of it will come from Social Security. So very little. The best case is $100,000, you get 27% from Social Security. So if you want 200, say, you have to come up with another 84% of that. And this chart on the right side of this chart is really important because if you look at it, if you take Social Security at 62, which you can do, and you can take it at any point between then and 70. And the key factor here, you guys know how to read a table, is if you think you're going to live to 79-ish, you're better off waiting to age 70. If you think you're going to have a problem in your early 70s, you probably should take it early. So we all think we're going to live to 95 or so, right? So everyone's going to wait till 70. I know I am. But it just is 67, it's full retirement age. And so if you just wait till 70, the difference between age, I can't see the, so it's at 70, it's $3,900. And at full retirement age, it's $3,200. So it's a lot of extra money, probably at a time when you're going to need it. All right, let's talk about the basic tax-deferred programs, 401k, 401k catch-up if you're over 50. So you can put 19 in now, plus a catch-up. And then you can have a match from your employer up to a max of 37. And depending on your situation, some employers put in a lot, some put in just the minimum to, for their employees. It all depends on what you want to put in. If you're less than 49, you don't have that catch-up. So that's a lot, but it's not going to solve Sam and Alex's issue. They need to save a lot more. And so we look at a cash balance plan, and it's become very common. It's become one of the most popular ways for employers under 100 employees to fund additional tax-deferred retirement. So it's age-based. So if everyone remembers the defined benefit program where you create a benefit for yourself in the future, then you fund it now. It's a version of a defined benefit plan. And you can put up at $283,000 at a certain age. I think it's 60. The participants can choose to be involved with it or not be involved. They could, if it's available to them, they can say, well, I want to put $10,000 a year in, or I don't want to put anything in, or I want to put $150,000 a year in. And the people in their peak earnings that are making $500,000, $600,000, this is very attractive. You have to fund it for at least 3 years, a fixed amount. And there's other places you can get it from year-end bonuses or just reduce your payroll. You have to fund it by the end of the year or by 9/15. There has to be just one pool for everybody that participates, and it has to be done very conservatively because it actually has a government backing to it. So they want to make sure it's conservatively done. So typically, some of the older cash balance plans, they tie their targeted rate of return to something like 4%. A lot of them tied it to the 30-year Treasury bond, which is now under 3%. But before it was 5-6%. So they just buy Treasury bonds. So it has to be managed pretty conservatively. You can't just throw it in the market at 100%. So and it has to be evaluated every year. So it's relative to other plans, it can be expensive, but the tax savings are fantastic. But here are some of the stats on it. It's been around a while. It's survived some tests. It's been growing rapidly, more rapidly than 401k plans. They're a third of all defined benefit plans. Most of them were smaller employers. a lot of money going into it. Employers tend to contribute more when this is available, and I think it's because the higher paid people are paying in more. That's why that number looks high. And most are pretty significant size with medical practices and professional groups, attorneys mostly comprising the number of people using it. And so when you add this to the mix, so you add your 401k back in here, and then you look at different ages and how much money you could actually put in pre-tax into a cash balance plan. And then you move over to the right, and how much does this save you in taxes if you do this? So instead of that money going into the Treasury, U.S. Treasury, it stays in your account. And hopefully when you take it out, and you can take it out almost, when you decide to get out of this, you can roll it into an IRA and then take normal minimum distributions.
Dave, couldn't you make the argument that we're not going to see taxes, federal taxes, as low as we're seeing it now, again in our lifetime? So perhaps it's best to pay your taxes now and then invest how you will?
Well, hopefully you're not going to have the earned income that you have now. Oh, I'm sorry. The question was if he doesn't think that taxes are going to go down in the future. So you might be better off paying the taxes on that money now and instead of 15 years from now. And my response was that you're not going to have the same earned income you have now, so that alone should, even if they raise taxes, that alone will drop down what your tax rate is. So does that answer your question? See me after. Yeah, they can't go up too much because you're going to be a retiree.
Dave, some of us doctors have very high-level employees, like physician extenders that make six figures and nurses that make over 60,000. I had 17 CRNAs, so me giving them a plan the same as I was going to get was going to cost $1 million. So it was, I don't know if it's still like that, but what I gave to myself in that type of plan, I had to give to them.
You probably had a very high max from the employer so that you could max out at that $37,000. But when you do that, you have to raise the percentage of the max so high, and then you have to do it for all your employees. So the cash balance plan is a voluntary thing. Somebody can decide that, hey, you make it available, and each individual employee can decide, well, I want to put $100,000 a year. I want to put $10,000 a year in. The fact is, it's mostly the real high-paying people that participate, and there's no testing.
And there's no matching?
There's no matching. It's your money. You're just reducing your income in that year by that amount, and it goes into a pool of that's managed conservatively. Sir?
Is it managed by a third party?
It has to be custodied somewhere else, and typically you hire an investment manager to do that.
And is when you retire, is there the same limitations like you have an RMD, you have to take out your...
Exactly. So when you decide to leave employment and you want to take your money out of the cash balance plan, you can roll it into an IRA, and then it's subject to the normal required minimum distributions.
If you don't roll it, can you leave it?
Probably for some amount of time. Your employer might not like it. I don't. I think you have an option. You could do either way.
The IRS wouldn't like that.
No, I think it's a problem when you don't work there anymore. I think they want you to move it along, but I'm not completely sure of that. So I know this. Some of the doctors I work with make a lot of money, and they jump all over this because you can defer so much. So if you, back to looking at current tax rates, and I've projected a future tax rate. So if you take that $100,000 and you pay the tax on it, you're gonna if you take the 150 that you go to is it 100? Okay, you want to invest 100 post-tax. So if you do it pre-tax, you can put in 153,000, or you can put in the 100 after tax. And With the pre-tax, you're paying basically, what is this? I'm sorry. Okay, so it grows. They both grow at the same rate. And then when you go to take the money out of the taxable, you're probably just going to pay a cap gains rate on the appreciation of the securities. And hopefully in retirement, the cap gains rate, you'll have lower income, so your cap gains rate will be lower.
Wouldn't that be 23.8%?
Well, that would be, normally it's 20% plus 3.8 for the Affordable Care Act if you're above a certain income level. And what I'm saying is your income level is going to drop. So you probably won't be at that level. You'll be at the, I don't remember off the top of my head. I'll get one of my accountants to, but if you do pre-tax and the savings is substantially higher, and then you're going to pay ordinary income tax on that just like you would an IRA. So the net return is much better saving tax deferred and paying the taxes later. It's a big difference. So here are the recommendations that I basically have, and then everyone go to the bar. Again, it's not what you earn, it's what you keep. And you should do a checkup on yourself at least annually. Get a net worth statement. Look at your financial plan, because it should feed to your financial plan what you have.